Welcome to Financial Insights in Minutes, where we summarize the day's top financial videos to save you time. Today, we explore the question, are we staring down the barrel of a recession?
In this episode, we'll analyze the latest insights from several experts about market changes, job reports, and investment strategies.
Stay tuned as we break down alarming trends and predictions that could impact your financial future. First, Clem discusses the market crash's immediate impact and future predictions. Next, James Lavish highlights looming recession risks and opportunities for gold and Bitcoin. Lance Roberts assesses how long the market sell-off may last amid recent economic indicators. Mike Green argues the U.S. economy is almost certainly in recession, leading to cautious investment strategies. Chris Ciovacco explores parallels between today's market signals and the infamous dot-com bust. Joseph Wang breaks down this week's massive market volatility and its prime drivers. Finally, Blockworks Macro explains what's driving the unprecedented market unwind. Ahoy and welcome aboard. Today we're navigating through tumultuous market waters with none other than Clem, CEO of Online Blockchain. Buckle up as he helps us make sense of the current financial storm.
Exactly. Clem's insights will guide us through today's drastic market shifts, especially after the jobs report that sent shockwaves through Wall Street. Let's get straight to the facts.
So what's the crux of today's calamity? Why are the markets in freefall?
The central thesis here is that the recent market upheaval is primarily fueled by sudden changes in money flows, influenced by unfavorable economic reports and shifts in interest rates, highlighting a complex global financial landscape.
Let's dive into some key points, starting with the job market. What do we need to know?
The unemployment rate has ticked up to 4.3%, with only 114,000 non-farm jobs added last month, far below expectations. That's not great news for the economy.
Big moves in the markets. What's the latest?
Absolutely. The Nasdaq tumbled 3% today, while the VIX, often referred to as the fear index, shot up 56%. That's a sign of escalating market anxiety.
What external factors are impacting the markets?
Japan's recent shift to positive interest rates is significant. As investors withdraw assets to convert back to yen, markets worldwide are affected. Cash flow is crucial.
And about cryptocurrency, what's going on with Bitcoin?
Bitcoin is currently around $63,000, showing significant volatility. It appears to be affected by broader market trends as investors scramble to liquidate assets.
What predictions are we hearing regarding market trends?
Predictions suggest we are in for more market corrections as uncertainty continues. Analysts are speculating about a Fed interest rate cut that could stabilize markets.
And what of Bitcoin's future?
Bitcoin's direction remains uncertain. Positive legislation could boost it, but expect short-term volatility as markets react to broader economic changes.
To wrap it all up, what should viewers take away from today's discussion?
Stay vigilant. Current market conditions call for strategic caution. Understanding global trends and economic indicators is key to navigating these turbulent waters.
Is there a final thought regarding market behaviors?
Indeed, investors must remain aware of how external economic factors influence market behaviors. Those who stay informed are more likely to succeed.
Welcome to Kitco News. Today, we're navigating the turbulent waters of the economy with insights from James Lavish.
Absolutely. James is here to unpack recent economic trends and what they mean for markets, especially regarding Bitcoin and gold.
What's the core thesis of James's analysis?
James argues that the U.S. economy faces imminent recession risks, which will likely lead to increased money printing and liquidity injections, ultimately benefiting assets like gold and Bitcoin.
Let's dive into key points. First, the jobs report. What's the scoop?
The July jobs report showed only 114,000 jobs added, falling short of expectations and raising recession fears.
What about the Federal Reserve's latest moves?
The Fed has kept rates high, but signals point towards possible cuts in September, especially amidst market pressures.
Wow, that's staggering. What implications does that have?
The soaring national debt signals fiscal irresponsibility and is tantamount to a ticking time bomb for the economy.
And what about Japan's monetary policies? How do they factor in?
Japan's recent rate hike signifies a shift in global economic dynamics that could affect asset prices worldwide.
What's James's outlook for the recession?
He predicts a heightened likelihood of recession soon, leading to more liquidity injections from the Fed.
And for investors in Bitcoin and gold, any predictions?
James forecasts Bitcoin potentially reaching 100 calories and gold seeing a strong rise, with both performing well through this economic turbulence.
What's the final takeaway for investors?
Stay vigilant. Investors should anticipate more liquidity support from the Fed, favoring hard assets like Bitcoin and gold in uncertain times.
Lastly, what about the political influence on Bitcoin?
The rising political support for Bitcoin, even as a reserve asset, showcases its growing legitimacy among institutional and political circles.
Ready to navigate this week's market currents? Welcome back to Thoughtful Money. Today's key question: how low will the market sell-off go? Joining us is the insightful Lance Roberts, a financial expert and the CEO of Real Investment Advice.
Absolutely. Lance brings over 30 years of experience in finance and investing. It's going to be an engaging discussion on current market trends and predictions.
So what's the emerging thesis in today's discussion about the market sell-off?
The current market correction appears to have further legs, potentially lasting well into October. Recent economic indicators, including payroll numbers coming in weaker than expected, signify larger underlying issues.
Let's break down those key points. What do the recent payroll numbers tell us?
The latest payroll figures showed only a 114,000 job increase, falling short of the expectations of 175,000. This downward trend raises concerns about the overall job market health.
And about that S rule, what's the importance here?
The S rule has been triggered, suggesting we may have entered a recession. It reflects a worrying trend in the unemployment rate when compared to the previous year's low.
What other economic signals should we be aware of?
Wages are dropping, and companies are hesitating on spending, which are solid indicators that the economy may be slowing down.
So what can we expect in the near future?
Experts believe in potential market drawdowns of 20 to 30% amidst these signals. However, a brief market rally could occur in response to oversold conditions.
What long-term trends should viewers keep an eye on?
Growth is likely to stay below 2%, which will put additional pressure on company valuations moving forward.
And what about market volatility?
Investors should brace for volatility over the coming months, necessitating a strategic realignment of investment portfolios.
To wrap things up, what should investors take away?
Investors need to prepare for a potential recession. Managing risks in your portfolio is crucial, especially as these economic indicators unfold.
Any final thoughts for investors navigating this landscape?
Absolutely. Staying informed and adaptable is key as market dynamics continue to shift.
Ahoy everyone, welcome back to Blockworks Macro. Today's hot topic: are we already in a recession? Joining us for this intriguing discussion is Mike Green, Chief Strategist at Simplify Asset Management. Get ready to sail through the stormy seas of the economy.
Absolutely. Mike has his finger on the pulse of financial markets. His insights on economic data and the Fed's actions are sure to enlighten us. Let's get straight to the facts.
So what's Mike Green's core thesis on the current economic climate?
Mike argues that the U.S. economy is almost certainly in a recession, starting as early as the fourth quarter of 2023, as indicated by a spike in unemployment and disappointing job gains.
Let's tackle those key points Mike discussed, starting with the job market data.
Indeed, the unemployment rate saw a notable increase from 4.1 to 4.3%, resulting in an additional 7.2 million unemployed individuals. That's quite alarming.
And what about the Fed's perspective?
The market is now pricing in a 65% chance that the Fed will opt for a double cut in their upcoming meetings, shaking the financial waters.
Fascinating views on passive investing. What did Mike say about its impact?
Mike highlighted the growing dominance of passive investing, suggesting it's significantly inflating valuations by pushing larger companies higher while reducing volatility, which can create false security.
Now, what are Mike's predictions based on these observations?
He predicts that the recession could deepen before any positive signs appear. Meanwhile, continued inflows into passive investing may lull investors into a false sense of security.
To sum it up, what are the key takeaways from Mike's discussion?
Mike stresses the importance of being cautious, as the markets may be operating under misleading signals due to passive investing. It reminds viewers to stay alert amid this economic turbulence.
Welcome to CiovaccoCapital. Today's topic explores an intriguing question. Is 2024 eerily similar to the 2000 dot-com bust? We're diving into some fascinating charts and market signals.
Absolutely. Chris Ciovacco delves into economic indicators and past market behaviors, giving us valuable insights into the current situation. He has a rich history in market analysis, making his perspectives compelling.
What's at the core of this discussion?
The crux of the analysis is that signals from the bond market, reminiscent of those from 2000, could suggest a downturn. Historical patterns seem to echo echoes of a warning.
Let's break down the key points. First, the labor market has some worrying statistics.
Yes, the charts reveal 1.54 million workers were not working due to weather, significantly above average. Plus, temporary layoffs surged by 14.8%.
And what about market sentiment?
The bond market's shift in demand raised alarms similar to 2000. Following a comparable signal back then, the S&P 500 suffered significant losses.
Interesting. How does the current market's volatility compare to 2000?
Today's volatility looks surprisingly better. Current trend strength scores indicate a more resilient market than we saw in 2000.
Any insights into the VIX spikes we're seeing?
The VIX surged over 40%, showing market jitters, yet history suggests these spikes often lead to recoveries.
What does Chris predict moving forward?
There's a chance of a 5 to 10% decline in the S&P, especially if labor market trends worsen. If the employment numbers stay weak, the market could react negatively.
What about the tech sector?
Historically, tech stocks show resilience and recoveries post-corrections. Average gains can be encouraging after downturns.
What are the main takeaways from today's analysis?
Vigilance is crucial. Keeping an eye on economic indicators and historical data is key for navigating potential downturns and making informed investment decisions.
Welcome back to the channel. Today, we're diving into the whirlwind of this week's markets. Buckle up, because things are a bit choppy out there.
That's right. We've got some significant market volatility to break down, and Joseph Wang has a keen perspective on what's really driving these shifts.
What's the main thesis from Joseph's update?
Joseph argues that current market volatility is largely driven by the collapse of two popular trades: escalating geopolitical tensions and growing recession fears among investors.
Let's talk about those trends. What's been happening with the S&P 500?
The S&P 500 experienced wild price swings this week. After an optimistic rise post-Fed meeting, things took a nosedive.
What about those key trades Joseph mentioned?
The yen carry trade and short volatility positions have exploded, forcing many to unwind their trades, causing a ripple effect in the markets.
And what about global factors? How are geopolitics playing a role?
Geopolitical tensions in the Middle East are escalating, particularly following provocative actions by Israel, which could lead to significant military conflicts.
Lastly, what's the scoop on recession fears?
Following weaker-than-expected jobs data, the unemployment rate ticked up to 4.3%, raising red flags for many investors.
What predictions does Joseph make for the future?
Joseph believes that once the dust settles, the yen and other affected trades may rebound, but geopolitical factors will need careful watching.
To wrap this up, what are the key takeaways?
Overall, Joseph emphasizes the importance of being vigilant as market volatility continues, driven by a mix of speculation, geopolitical unrest, and economic signals. Investors need to remain agile.
Welcome back to Blockworks Macro. Today's hot topic: why are markets experiencing this unprecedented unwind? Our analysts are here to break it down for us.
Absolutely. There's definitely a lot of weird stuff going on below the surface. Markets are reacting in ways we haven't really seen before, so let's get straight to the facts.
So what's the core thesis behind these market movements?
The main takeaway is that the unwinding markets are driven by falling yields, risk-off sentiment, and geopolitical uncertainties that are shaking the foundations of investor confidence.
Let's break down those key points. What can you tell us about yields?
Well, we're seeing yields take a nosedive, indicating a flight to safety. This drop is fueled by soft economic data suggesting a potential recession.
And what's happening with the Fed's policies?
The Fed's normalization approach appears to be lagging. Many analysts are predicting an impending need for rate cuts, which is fueling further market volatility.
Interesting. What about market structure?
We're seeing a close connection between currency fluctuations, especially the yen, and large-cap tech stocks. Plus, structural issues in the market are creating extreme volatility.
Now, let's dive into predictions. What's on the horizon?
There's potential for a market recovery once the Fed begins to cut rates. However, much hinges on coming economic data. We need to keep an eye on job reports and inflation.
What about geopolitical elements?
Ongoing geopolitical tensions might add to market fluctuations. Investors are likely to continue favoring safe haven assets during uncertain times.
So, to wrap up, what are the key takeaways from today's discussion?
In conclusion, navigating these choppy waters necessitates awareness of shifting global economic signals and how Fed policies may impact market dynamics. Stay tuned for updates.
Today's discussions shared a common thread: concerns over rising unemployment and economic instability.
While Clem Chambers feared further market declines, James Lavish remained optimistic about Bitcoin and gold.
It's essential to stay alert and informed. Thanks for tuning in to Financial Insights in Minutes. Thanks for watching Financial Insights in Minutes for August 3rd, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.